Over the past 19 months, I've managed to beat SCHD using its own strategy with a few minor twists. As it stands today, my dividend growth portfolio is up 27.83% more than SCHD. Since launch, my portfolio has returned 40.06%. Meanwhile, SCHD has returned only 12.23%. Not only is my strategy beating SCHD, it is also keeping up pace with the S&P 500. Let me tell you exactly how I did this, and why I believe this outperformance should continue in the future. First, I'll explain how the strategy works, and why I believe it's better than SCHD. Then we'll take a look at the actual portfolio. I'll talk about the analysis I am constantly doing to further optimize this strategy, and a few changes that should make it even better. And finally, I'll touch on the one area where SCHD is still slightly better than my strategy, but why I believe I can best SCHD here as well in due time. Let's begin with the strategy. I'm sure most of you are familiar with SCHD. The fund's objective is to track the total return of the Dow Jones US Dividend 100 Index. The index basically selects the best 100 stocks, focusing on quality and sustainability of dividends. It does this by following a set of simple rules that analyze and rank a few thousand stocks each year. And this process has worked out quite well. During the past decade, SCHD has grown at 11% per year, which is just 1.6% slower than the S&P 500. Bear in mind that beating the S&P 500 is a very difficult task, and it's also not a goal that SCHD is set out to achieve. SCHD's primary goals are to create a sustainable and growing dividend stream, all the while providing a reasonable total return. When I looked closer under the hood of the underlying index, I thought to myself, since this process already works so well, why not just borrow it and look for ways to optimize a few aspects and ideally make it work even better? That is exactly what I did. The goal was to simplify the strategy as much as possible and steer it towards higher quality stocks. In my opinion, the Dow Jones US Dividend 100 Index equally balances business quality with dividend sustainability, and it also emphasizes a more attractive dividend yield. I believe that by placing more emphasis on business quality versus dividend sustainability, you can improve your outcome while also meeting the same or better dividend results. If you think about it, not all companies with strong dividend histories are great businesses. It's possible for a declining business to maintain a strong dividend growth policy if it has surplus cash on hand. Conversely, a great business that has an established commitment to paying and increasing dividends, in my opinion, has the potential to have a better dividend growth policy in the future. This, of course, won't be true for all cases, but on average, this mentality has the potential to generate superior results. So how exactly do I do this? Well, the primary difference between SCHD and my strategy is the starting universe of stocks used to build the portfolio. I apply a much more rigorous screening process to come up with my initial universe, and I believe this gives me a much more tailored list of potentially high-quality companies to choose from. The screening process is as follows. Number 1, I look for stocks that trade on the New York Stock Exchange or the Nasdaq, because I want to easily be able to invest in the stocks this strategy generates. Number 2, I look for companies with a wide or narrow economic moat, as rated by Morningstar, because I want to invest in companies with a competitive advantage. Number 3, I look for companies with a standard or exemplary stewardship rating, also from Morningstar, because I want to invest in companies that are run by competent people. Number 4, I look for companies that have grown their revenue stream by at least 5% on average per year over the past 5 years, because I want to invest in growing businesses. Number 5, I look for companies that have grown their earnings per share by at least 5% on average per year over the past 5 years, because I want to invest in companies that convert top-line growth into bottom-line growth. Number 6 and 7, I look for companies that have grown their dividend stream by at least 5% over the past 3 and 5 years, because I want to invest in companies with established dividend growth policies. And number 8, I look for companies that have a payout ratio no higher than 80%, because I want to invest in companies that have room to increase their dividend payments in the future. Generally, when I run this screening process, it generates a short list of about 100 to 130 unique companies. Once I have this list, I rank all of the stocks in a similar fashion as the Dow Jones US Dividend 100 Index. The ranking process is based on 4 financial metrics. Number 1 is the free cash flow to total debt ratio. That tells me how leveraged a given company is in relation to the free cash flow it generates. Number 2 is the 5-year dividend growth rate. Number 3 is the return on capital. This is the one differentiator from the Dow Jones US Dividend 100 Index that instead uses the return on equity. While both metrics measure profitability, I favor return on capital because it factors in debt financing into the equation. And number 4 is the forward dividend yield. Once the ranking is complete, I have my short list of potentially high-quality companies ranked in order from the most to least attractive, and from here I make my selections. Once my selections are made, I hold these positions for 1 full year, and then I repeat the same process again. Now, for the first year, when I launched this portfolio, I chose the top 30 ranked stocks, and I applied a weighting system to set the initial asset allocation, following on the approach taken by the Dow Jones US Dividend 100 Index. After carefully analyzing the data for the first year, I found that choosing fewer stocks and setting an equal weight allocation would not only make this strategy simpler, it would have also led to better results. So when this portfolio was rebalanced for its second year, I chose the top 25 ranked stocks and gave each of them an equal weight of 4%. I am again analyzing the data from the second year, and I have a few optimizations that might go into effect for year number 3. I'll explain what these are a little bit later. For now, let's take a look at the actual portfolio. The portfolio is made up of 25 stocks: ADP, ASML Holdings, Broadcom, Cohen & Steers, EOG Resources, Fastnell, Home Depot, Infosys, Lowe's, Lam Research, Landstar, MasterCard, Masco, Microchip Technology, Monolithic Power Systems, Old Dominion, Paychex, Robert Half, Rollins, SQM, Skyworks, Texas Instruments, UPS, Williams-Sonoma, and Watsco. These 25 stocks were chosen on October 31st, 2023, and the portfolio was updated with the new selections on November 1st, 2023. The current value of this portfolio is only $2,500. I have since invested more capital into this strategy, probably between $150,000 to $200,000 in total. But since this was the first pilot portfolio that was launched in November of 2022, it makes for a great resource to measure how well the strategy works. I am also not adding any money to this account, so it's much easier to track performance and dividend growth. At the start of each month, I rebalance this portfolio to bring each position weight back to the original 4%. Since this is a tax-deferred brokerage account, there is no capital gains impact from doing this. In its first year, this portfolio returned 10.9%. Meanwhile, SCHD had a return of minus 4.51%, which means the strategy delivered 15.41% of alpha. The portfolio also managed to outperform the S&P 500 by 0.75%. Following the month of May, we are 7 months into the second year, and thus far the portfolio has a return of 26.29%. Meanwhile, SCHD has a return of 17.53%, which equates to 8.77% of alpha. The S&P 500 has been pretty strong this year, and it has a return of 26.98%, placing it 0.69% ahead of my strategy. My portfolio doesn't outperform SCHD or the S&P 500 every month, but overall it has shown that it has the potential to generate very strong returns. In year 1, the portfolio beat SCHD in 7 out of the 12 months, and it beat the S&P for only 5 out of the 12 months. In year 2, the portfolio outperformed SCHD for only 3 out of the 7 months, but these few winning months generated a lot of alpha, and the 4 losing months were not that bad at all. I have no idea how this strategy will perform in the long run. There are no guarantees in the stock market. But conceptually, the process makes sense to me, and for that reason, I believe this strategy has the potential to see its strong returns continue in the future. There are 2 areas where I focus my attention when analyzing the monthly return data. The first is whether concentrating the strategy around fewer stocks would lead to better results. Thus far, the answer is yes. Had I opted to select only the top 20 ranked stocks instead of the top 25, I would have seen even better returns. The top 20 stocks have generated an excess return of 2.88% over the past 7 months relative to the top 25 stocks. This is certainly one consideration that I think I will implement into this strategy for year number 3. The second aspect I am analyzing is whether the monthly rebalancing, where I true up the weight of each stock to bring it back to the original 4%, is working out favorably, opposed to not rebalancing at all. And the answer here is no. The monthly rebalancing is not shown to generate more favorable returns. The margin of difference isn't as high as with the more concentrated portfolio. The non-rebalanced version of this portfolio would have generated 0.57% in excess return over the rebalanced portfolio. This is the second aspect I am considering changing in year number 3. Both these changes would further simplify the strategy. Not having to rebalance this portfolio every month would make this a much more passive portfolio, and investing in fewer stocks would also make tracking and reviewing this portfolio easier. I have until the end of October to decide if I will implement either of these two changes, so there's still some time for me to decide. Now, let's get back to the portfolio, and let me touch on the one area where SCHD is still superior to my strategy. That is the dividend income department. My portfolio currently yields about 2%, whereas SCHD offers a dividend yield of 3.5%. That is quite the gap. Unfortunately, by opting to invest in higher quality companies, my strategy does sacrifice some of the attractive yields SCHD offers. However, I believe this is a short-term problem that will be solved in due time. Let me explain. Because my strategy has shown to grow at a faster pace, the dividend income this portfolio has generated has also grown faster than the dividend income from SCHD. I measured how much dividend income SCHD would have paid me had I invested the same amount of capital on the same day this portfolio was started. Let me break down how this income difference has changed during the last 19 months. Quarter 4 of 2022 was the first quarter for this strategy, and my portfolio generated only $5.16 in dividend income, while SCHD paid $17.13. That's an almost 70% difference. However, my portfolio was launched in November, so it not only missed an entire month of dividends, we also weren't able to capture many of the November dividends as well, since I missed the ex-dividend dates. In quarter 1 of 2023, SCHD generated 28% more dividend income. In quarter 2, the gap was 34%. In quarter 3, it was 31%. And in quarter 4, it was only 13%. When I look at the entire first year for this strategy, it came up 36% short of SCHD in terms of dividend income. Year number 2 is still ongoing, but when I compare the dividend income for the first 6 months relative to the first 2 quarterly dividend payments for SCHD, the gap is only 18%. This means that if this trend holds true for the remainder of the year, my strategy would cut its shortfall to SCHD in half. At this pace, there is a potential chance that this portfolio may catch up to SCHD in year number 3, and if not, then certainly in year number 4. Now, there are many factors in play that could change this trend. For example, the dividend income from this strategy is highly dependent on the chosen stocks each year. The newly selected stocks for year 3 could pay a higher starting dividend yield, which would shorten the amount of time needed to catch up to SCHD. But they could also have a lower starting dividend yield, which would then require more time or more dividend growth to catch SCHD. It'll be interesting to see how this plays out in the future. As of right now, the portfolio is seeing a 12.11% dividend CAGR. This is based on the projected annual dividend income as of today, relative to when the portfolio was first launched. My portfolio runs on the November 1st to October 31st cycle. This just happens to be the day I started this portfolio. But I run the screening process every month, and have been doing so since June of last year. I was curious to see how this strategy would perform on any 12-month cycle of the year. I can tell you that as of right now, every single 4-factor portfolio made up of the top 20 ranked stocks is generating a total return that is better than SCHD. Some of these portfolios are also beating the S&P 500, while some are not. I intend to track each monthly list for a full 12 months, and then analyze the results to measure the effectiveness of the strategy. Thus far, only one monthly list has completed the full 12-month cycle. That was the June 2023 4-factor list. It finished with a total return of 31.5%, relative to 17.06% for SCHD, and 28.09% for the S&P 500. I share the tracking sheet, as well as each new monthly 4-factor list with my Patreon community if anyone is interested. There's a free 7-day trial to see if you like it. I hope you enjoyed the video. If you did, please do me a favor by giving this video a like and subscribing to the channel. Thank you for watching, and see you next time.